Welcome to another stage analysis video. It's Sunday the 24th of September 2023. Got a lot to get through this weekend as always. Back from my break now. Did a little midweek video just to do a catch up on some of the shorter term price action. We're going to go through see the charts, the breadth, the industry groups, relative strength rankings, etc., and the watch list in a bit more detail now to see what's really been going on as we had a heavy week in the market. Start off with the major indexes. The S&P 500 here you can see was this most significant pullback it's had since this March bar here, where it made just before it made the swing low. We've had a little bit of a correction over the last month or so, starting off in early August. So seasonal weakness coming into play at the moment as the major markets, the S&P 500, Nasdaq 100, etc., have been moving higher in stage two. We're now in that corrective phase, first major base that we've seen during that, while some of the other markets have failed to move into stage two, like the NYSE, which has had a failed breakout, for example, and the Russell 2000 also did the same. So interesting divergences going on via the different indexes, etc. At the bottom of this chart, you can see we've got our custom combined percentage of stocks above their 50-day, 150-day, and 200-day moving averages chart, which shows that crucial market breadth data that's really, really useful for market timing and strategy overall. So when we're in this period here below the moving averages here, we're in what we consider a difficult environment. You can see from a percentage basis, it's all the way down at 32% there at the moment. I think it's a little bit below that, it's 31 point something. But below the 40% level is what we consider the weak stage 4 type environment. So although we're the index S&P 500 here is up in stage 2, consolidating, potentially early stage 3, even with last week's behavior, it's knocking on the door of early stage 3 potentially. You can see the broader market, this covers over 5,000 stocks here, is all the way down at only 32% above their short, medium and long-term moving averages. So a little bit of a different picture going on there compared to the S&P 500. You can see we've had the ABC type correction here at the moment, so this could potentially spring here if it start to shore up at the rising 30-week moving average. If we drop down to the daily chart, you can see there's a base structure going on here. We had the buying climax bar, automatic reaction, secondary test, and so we're in phase B. So we're in a undercutting here in phase B at the bottom of the base structure. So this could potentially turn into an early phase C attempt here if it does spring back into the range again and start to push its way back up. But obviously, if the weakness continues, then a 200-day moving average test could be on the cards here. As you can see at the moment, still sitting a bit above that, about just over 3% below, above the 200-day moving average here at the moment. So could quite easily test that. And that would take it all the way back down to the stage 2 breakout area here, which it struggled to push its way out of initially. So an area of support below with both the 200-day moving average and obviously this zone of support resistance, which was key over the last few years. We go back onto the chart here. This was a major area of support resistance. You can see it was tested multiple times throughout 2021, 2022, and then breezed through it eventually in 2023 here, and now we're sitting right at the top of that again. So this is we're in an area of potential support as it pulls back in here during this seasonally weak period. So we're still about a month away until the seasonally strong period starts. It's the last week of October into the end of the year, start of the new year is generally the strongest period of the year. So potentially, if this doesn't fall apart here, I've seen many 1987 predictions coming up at the moment as we move into this, as we've got a similar near-term pattern going on, but we don't have the longer-term pattern going on. The 1987 crash happened after a well over 100% rally for 3 years or plus. We've had a major stage 4 decline just in the last year, and we've only just come out of that. We're only 30% above that. So this bears more similarities to the 1985 level if you're looking for an analog, in my opinion there. But either way, that stuff is all just conjecture. It's this at the moment. The near-term price action shows that we're in a corrective phase. It shows the overall market is weak, and so defense is obviously the crucial strategy at the moment, as the market has the ball, as we say, and it's trying to score against us. So if we go back to the daily here, you can see percentage of stocks above the 20-day EMA has dropped all the way down into the lower zone. So we're at 15% at the moment. So we're in the lower risk area now. We look for reversals back out of the lower zone. Remember, market breadth is a contrarian tool. We look for reversals from the lower zone when we're looking to get long, and we look for reversals from the upper zone when we're looking to go short. So once you start to drop from the upper zone back down again, that's when it starts to turn negative. You can see here at this period through here, that's where that started to happen last. And now we're back into the lower zone here. We had the move out here from the 30% level, started to push its way back up again, got back above the 180R level, but then has rolled over again. We're now back at the lower zone once more. So if we get us a move back up through the key 30% level, ideally through that 50% level as well, and pushes up back towards that upper zone, obviously that's a point to start to get interested again if it does that. Obviously, once you're in the lower zone, it can hang around in there for a while. So a test back to the 200-day moving average is, like I said, not off the cards here, with a lot of people looking for weakness in the near term, especially with the seasonal precedents that we have. Nasdaq 100, similar kind of look to it. You can see the rising 30-week moving average is still strongly rising. You can see there is some breakdown in the breadth here. You can see this is the percentage of stocks above their 200-day moving average in the Nasdaq. So it covers about 3,000 or so stocks, the Nasdaq composite. So you can see we're still within this broader range here at the moment. You've got a little bit of a head and shoulders that people have been highlighting, but obviously a high right shoulder here. So at the moment, a near-term breakdown, but 60% is still in the strong zone. We've still got close to 2/3 of stocks on above their 200-day moving average. And if we drop down to the daily time frame here, you can see a little bit stronger than the S&P 500 in that it hasn't yet tested this August low at the moment, but very, very close. So again, it's in position where it could potentially spring if there's some near-term strength. Could see a rebound attempt at the support resistance, a liquidity grab down here as it drops back below, but also a 200-day moving average test could be on the cards if the weakness persists here. So again, 14%, well down into the lower zone now, so it's in an extreme level, so potential for a reversal, for a swing low to develop in the near term. So keeping an eye on that, as it's in a potential Wyckoff phase C position if it does form a spring. Look at the composite, similar kind of behavior, coming back in again, near term base developing again, kind of head and shoulders type pattern that people have been highlighting. Only 28.32% of stocks above their 200-day moving average in the Nasdaq composite. So it's been consistently weak throughout the year. What you do note with the Nasdaq composite is that the Nasdaq has a much higher percentage of the healthcare type stocks. So the healthcare sector, when I do the sector breadth I do it every other Monday, is the largest group. There's over 1,000 stocks in the healthcare sector, and obviously lots of those being biotechs, etc. And they've been some of the weakest areas in the market all year, which has held the Nasdaq composite breadth back, basically. That's been a real laggard in the group. So that has been one of the factors of why this has stayed so low. So if you look at that from a different perspective without that data, then that seems a little stronger in that regard. So something to take into account at the moment. As I said, same with the Nasdaq 100, pulling back to near the bottom end of the base structure. So still hasn't tested the lower end, really close low. So potentially, again, buying climax area, automatic reaction, secondary test. So in phase B, could, if it undercuts, forms a spring, turn to phase C. But obviously, if the weakness persisted once more, 200-day moving average test would be on the cards, as that's not far away at all there. Only a 5 to 6% move to get down to that. Look at the NYSE, you can see the failed stage 2 attempt recently. So failed stage 2 breakout week there. Only had a 2 weeks above before rolling back over again and coming back in. We had this significant bar, and now we've had a secondary significant bar, which has taken it below that swing low, below the 30-week moving average there. So from an investor stop loss percentage, if you were taking this kind of area for your stage 2 breakout, this would be where your stop loss area would be, and hence you'd be touching just onto that at the moment. You can see percentage of stocks at 44.63, so showing stronger than the Nasdaq still, but still have a very choppy, mostly sideways move over the course of the year since after it got out of that initial move from October to December there. It's basically gone sideways for the majority of the year here in the NYSE. You can see that the near-term weakening of the percentage of stocks above their 200-day moving average, but still in what we consider the neutral range. So between 40 and 60% is neutral area. So just getting down towards the lower end of that. So at the moment, give that a neutral minus there. Russell 2000 as well, another failed stage 2 breakout attempt as undercut. That would have been stopped out with the investor stop loss there now. So Russell 2000 has failed and come back in. So back into the broader stage 1 base structure again. Obviously, if it continues to weaken, could easily roll over into stage 4, but at the moment back into stage 1 here. And it's been a very, very choppy affair for this, but still within this much broader structure. You can see Russell 2000 has basically gone sideways for the year, and if we break this up into, get the quadrant tool on, which breaks it up, we go. You can see here now just dropping below the 50% level here. So you can see the majority of the price action recently has been above that 50% level. So it had some near-term strength, but this move back below, potential sign of weakness developing there. So we look at it from a daily, you can see the clear break below the 200-day moving average here. This is why some people might consider the move, the failed stage 2 and back in, and this starting to come down here into potential stage 4, but obviously with the broader area in context, it still would be considered stage 1 at the moment. If it does form a swing low below here and then pivot, runs back up and then goes back below, then potentially that could be a stage 4 breakdown point. But at the moment, would still give it the benefit of the doubt as back into the broader stage 1 range at the moment. You look at the VIX, you can see that this is pulled back up towards the 200-day moving average. Talked about this, I think it was a couple of weeks ago back here, maybe it was on the midweek one, but basically it was starting to move out, starting to show some volatility returning. Talked about obviously the 200-day moving average being the key for the VIX here, which gets back above that. Obviously that's when we move to more significant negative territory. At the moment we're in a neutral area just below the 200-day moving average. It's basically on the borderline here. So, but if it can, there is some potential near-term resistance for it to turn there. So keeping an eye on that one. It's obviously a break above the 200-day moving average, and consistently holding above that would obviously see the market break down more significantly. But if this can reverse here, then we could get that rebound spring type attempt from the market could occur. So depends whether it gets up and holds. If it gets up and holds, then this is off to the downside.